This is the worst 6 month start to a year since 1970. Happy Friday. It is July 1st, and what I wanted to do is I wanted to take a few minutes just to give some market updates here with the first half of the year, the first half of year 2022. So welcome to Financial Fitness Friday. So we're going to be doing this first half update, getting right into it. So investors are proceeding into the second half of 2022 with a lot more caution after we've seen this first 6 months had the worst start for the stock market in decades. This is the worst 6 month start to a year since 1970. So risk off sentiment that has been seen in most areas of the market. Why? Well, fueled by soaring inflation with the Federal Reserve's aggressive money tightening policy. So that's leading to fears of slowing growth, increasing borrowing costs. Like you've seen interest rates go up on everything, especially mortgages. Like the mortgage rates have doubled in just a few months. Last July, I think, and we might have closed on July 1st, we refinanced our primary residence to 2.75 and refinanced a rental property to 3.5%. A rental property, 3.5% on a 30-year loan. Right now, the last I looked, a 30-year loan on a primary residence is 6%. I've got a rental lower than that. I'm about to close on Wednesday. Started the process like 30 or 45 days ago, locked in at 5.5. But now even, that's a cash out refi and a rental. So the costs on that are much higher. The rates on that are much higher. So but it goes to show that just in the last 30 days or so, rates have went up so much that mortgage rates on a primary residence are now higher than what I'm doing on the current rental, and much, much higher than what I did last year. Again, mortgage rates on a primary residence, 30-year loan, about 6% here today. A year ago, it was 2.75% on our primary residence, 3.5% on a rental that we refinanced last year, about this exact same time. It was right at the end of June, beginning of July. So a lot of people are worrying about a recession, okay? And I talk about it a lot. I post about it a lot. And it's not to try to scare people. It's to try to just make you wake up and look at what's happening and make you think, depending on your situation, where are you at and what should you be doing? Like, if you are a pre-retiree or a retiree, and if your advisor has had you significantly exposed to the stock market, I make a joke, but I say, look, you probably want to fire that advisor, right? It's like if you're about to retire and you need this money for income, and you're looking at everything that's been happening in the economy over this past year, why in the world haven't they protected some of your assets and put them into retirement insurance contracts, like a fixed index annuity, for example? And if your advisor said, oh, we'll just rebalance the portfolio a little bit, we'll just have a little bit less exposure to stocks and increase your bond exposure. Well, that hasn't worked either. Actually, it's worked out worse because, for example, long-term treasuries, like 20-year treasuries, they have fallen in price more than stocks have this year. Now, the last I looked, the S&P 500 had fallen about 21%. Long-term treasuries have fallen 22%. So both stocks and bonds are crashing. So this traditional retirement planning of, oh, just do a little bit more bonds, it's blowing up right now. And why are bonds losing value? Because traditionally or historically, people think of bonds as like safe haven, safe asset. But the thing is, when interest rates rise, the price of bonds go down. And we're seeing that happen drastically right now. So if you're working with like a traditional financial planner, like you're probably getting killed, right? As far as like if you are retired or if you're getting ready to retire. Secondly, what about, I guess, for people who are not near retirement and maybe they're in their 30s or 40s? A lot of things that you should do if we're entering a recession. I mean, number one, I would say like, you have to shore up your financial foundation. And that can mean a lot of things as far as like cutting back on wasteful spending, whether it's, subscription services, whether it's things like, your cable, whether it's eating out too much, stuff like that. You want to beef up your emergency fund. You want to do things that are going to protect your money. One of the best volatility buffers, and I utilize it for myself, I utilize it for several clients, is a maximum funded cash value life insurance program. It protects your money. It gives you guaranteed growth. It gives you tax advantages. It allows you to move forward into an era of unpredictability and uncertainty. It gives you much more certainty moving into this era. And what it's allowing me to do, and many of my clients, not only are we able to look at stocks right now as being on sale and buying those stocks for cheap. And this isn't investment advice. I'm not saying that you should do that. It's what I'm doing. But I also know, like, look, I don't know that we're at the bottom of this market. Nobody does. Okay, nobody knows when the bottom is. I also don't know that this won't be a prolonged downturn. I don't know that stocks are going to be back up within a year or 2 or 3. Nobody knows that. Again, I'm not trying to guess the market. I'm not trying to time the market. What I do for clients is I put together a comprehensive strategy that allows them to move forward with more certainty, regardless of what's happening with the economy and with the markets. So because I have so much safe, accessible cash in my insurance policies, I'm able to confidently buy some of these stocks and ETFs that I like, that I'm able to buy them on sale and wait for the long term for them to come back. If we have a strong bounce within a year, great, I'm super happy with that. But if they don't recover for 5 or 6 years, I won't like that, obviously. But it's not going to kill me because I have other assets in place. I have other cash. I have real estate, and I have some crypto, and I have some precious metals. I have other tools outside of the stock market that give me the control, the liquidity, the ability to utilize my money while at the same time still growing equity. So those are some of the things that you can do to brace for a recession. If you're younger, you're still in the accumulation stage of your life, is again, like, look at your budget, cut out some of the wasteful stuff, beef up the emergency fund, make an intelligent decision. I would say don't start plowing a bunch of money into your 401k or stocks if you can't afford to do so. Because a lot of people, if you're a little bit more savvy, you might look at this, instead of being scared, as a buying opportunity. And I think that's a good way to look at it. But if you don't have enough safety in your plan, if you don't have enough liquidity in your plan, you might buy into these stocks. Maybe the stock market continues to drop another 10 or 15%. At some point, maybe you lose a job. Maybe you have some kind of liquidity crunch in your business, and all of a sudden you've got to liquidate your stocks or liquidate your 401k, and you're going to be locking in losses. You're potentially going to be paying early withdrawal penalties and income tax, that sort of thing. So it's really about getting your financial foundation in place with an overall program. Okay. Let's kind of transition now. And if you have any questions on that, you want to get some assistance or help or guidance, all you got to do, reach out to me. You can comment below. You can send me a direct message. Any of those things will work.